Okay, hello, folks. Today we are going to talk about a very, very important topic, which is really near and dear to my heart, and many others. People have asked me, what is this so called caste segregation study? So this is really a tax benefit study where basically most time your residential real estate you depreciate over 27 and a half years, and commercial real estate typically do depreciate over 39 years. And certainly, I'm not the CPA, I'm not an accountant, I'm not a person. So I thought to understand this completely, why don't we bring in somebody who really understand this far, far better than me and who actually lives with it and, utilize that tool for people's benefit. So tax, you benefit from the depreciation. You basically deduct certain portion of the value of your asset every year to take advantage into your taxable income. And if you have like a house or any residential real estate, you divide that overall 27 and a half years. But we know that not every single item in the house, like the floors, the roof, the windows, every single item does not depreciate over 27 and a half years. Every item, like floors, have different lifetime, kitchen has different lifetime, bathroom has different lifetime, and even in the bathrooms, there are certain items that depreciate sooner than later. So there are actually people out there who actually are specialized and they would do this segregation study for you. And hence, then you can talk to your tax guru, and then they would do certain type of schedules and help you depreciate those items, in the earlier year more than later years. And there are pros and cons of everything. And then now there's a new law. The big beautiful bill has something in that regards too. So to understand all that completely, I thought we invite in our studio today, my dear friend Steve Maloney, who is basically 20 years veteran and a CPA. He's my CPA, and I'm lucky to have him. And he basically has helped me over the years. And I thought we bring him today to basically understand, how does this work and what are the pros and cons both for residential and commercial. It was a little bit longer intro, but I just wanted to tell you what we're going to talk about today. So Steve, without further ado, why don't you help us understand just very high level, what is the uh, you know segregation study, and how does this really benefit, and how does this then relate to this big beautiful bill?
Okay, thank you. My name's Steve Thibodeau. Just want to introduce myself real quick. Connor Maloney and Company. And I've been with the firm coming up on 24 years, 25 years in practice. And yeah, Rashid and I work together, and we have a great relationship and working together. So I appreciate you having me on, Rashid, and happy to cover this on a more high level. Again, this isn't true tax advice in each person's situation. It's something to talk
Right.
to your advisor about and see how it can work for you.
Right.
So Rashid, you kind of hit on some of the high, the important points. Typically, you use a third party, whether some CPA firms specialize in this. There's some online CPA firms that there's software that you can utilize. Essentially, you pay them, pop in all your information, and depending on what size property, how many rooms, that kind of stuff, whether you qualify for that easier cost seg study, or if you use a third party, it can be much more expensive. I mean, on the low end, um, online software can be about $600 to get a pretty good study done, and that's on like $1 million property or lower, 6 units or less. And then it could be $10,000, $20,000 for a full service cost segregation study on a $5 million property plus something like that. Really depends on how much you have going on and who you use. Um, so what they do is they analyze the property. They go through how many bedrooms or rooms, or what is made up of the property. They come in, they look at it, they take pictures, and they analyze it. And they say, so the idea of it is to say, okay, instead of 27 and a half years on the building, we might be able to capture some 5, 7, 15 year, maybe 20 year, depending on what the breakdown is. Now, because of the big beautiful bill act that was just passed, they reinstated 100% bonus depreciation for federal purposes. We were going down to 40%, and now we're back at looking at 100%, and it looks like that's going to be set permanently. So so what's that mean? Well, if we can get a cost seg study done in the first year of owning the property, we can deduct 100% of anything that's allocated or broken out for 5-year, 7-year, 15-year qualified built leasehold improvements, and we can capture that all up front. So what does that do? Well, we depreciate more upfront, which defers taxes into the future. This study should put you into a loss in the first year. Either you're going to be able to offset other rental income from other properties, or just carry it forward if you can't utilize all of it. So it really pushes taxes out to the future. Now we're front loading, so over time, your depreciations could be lower than if you eventually is going to be lower than if you just had the 27 and a half or 40 year 39-year useful life. So that's one piece of it, is
Can I
front loading
stop you here?
depreciation. Go ahead.
Yeah, just sorry, just for a layman to understand. Let's say you have $1 million property. So definitely it's more beneficial if you do cost segregation study sooner than later, because now you have everything new, and you can do it anytime, but now you have everything new. And let's say that your floors and your other elements could be 5 to 7 years. Now the benefit really is the cash flow benefit. It's not really the total cost benefit. It's really the cash flow benefit that you are able to take the depreciation in 5 years or 7 years instead of taking it in 27 and a half years. Is that correct?
So essentially you're taking 100% of it up front on that 5, 7, 15 year. So you would get over 5 years of, but we're able to take 100% now. So yeah,
Oh,
it's a huge cash flow for tax purposes. So you're keeping all that money in your pocket to either invest in other projects or whatnot. So
mm. So
um,
let's say if that is $1 million, same example, and your depreciation, if it was 27 and a half year, that would be probably what, $10,000 in the first year if we use a regular 27 and a half year. Let's suppose. And now you can take this entire million year depreciation. So now that, of course, you don't pay any tax for now. Now you use, if you use all of it, it means you have leftover, because if you, let's say your tax due that year was only $30,000. Now you use the $30,000, but you have the million minus 30,000. You have all that, and then you can just keep rolling it next year. Is there any penalty or anything like that?
well, first of all, we're not going to get, if it's $1 million property, we're not going to get everything in the first year, because 27 and a half year is, that's the shell of, your framing, the crux of the property. You're still going to have 27 and a half years. You don't get to front load that piece of it. Now on $1 million property, just throw out some numbers, like you might get 250, maybe 300,000
Mhm.
allocated to that shorter life, and be able to front load that 250, 300,000 maybe. It really
So
depends on the
you still
property.
have
They're
to
all
do
different.
you still have to do cost segregation study and figure out what can be front loaded.
Right.
And
But I don't want to, you're not going to get a million up front. It's,
correct.
a $1 million property, we might get 25, 30%, really
Okay.
depending on what that house, that property is, and how it's constructed.
Okay, so if there was 5 to 7 year, elements, or even 10 year elements, those you can take all in the first year because of this big beautiful bill.
Well, yeah, I mean, this was around before, this through the 2017 tax act. This was really implemented. So it was really, that whole piece was phasing out now. And
Mhm.
the one one big beautiful bill act reinstated 100%, depreciation up front. So we've had this for a while. Now, I guess we don't have a lot of time. I'd like to kind of just move on to some of the other benefits to the cost seg study. Now, you mentioned roof. So we have a cost seg study, and in this cost seg study, the study says the roof is, I don't know, $50,000.
Mm-hmm.
Now we go a couple of years down the line and we got to replace the roof. Well, under the old method, we'd be stuck continually, the roof, $50,000 being depreciated over 27 and a half years, say it's for a multifamily. Well, now, because we have this cost seg study, we have to replace our roof. We're going to come out of pocket probably $70,000, $75,000 if it's a $50,000 roof, because it's never even. So, but what happens? Well, we have this report that says, hey, this roof costs $50,000, and we probably still stuck with 45, 46,000 net book value on this roof. Well, we get to write off that entire remaining net book value, and we bring on the new cost of the new roof, and we start depreciating that over 27 and a half years. So you can see there's an additional benefit, not just the depreciation up front. We're now able to, anything that we have to replace that's a long-term item, we can write that off and continue with the new one. Where under the old method, we now have 125,000 of roofing costs that essentially has to be written off over the remaining useful life. But the cost seg study says, hey, wait, we know what this cost. The roof is junk. We no longer own it, and we get to write that off. And so that's an additional tax deduction that a lot of people don't really understand, that these cost seg studies allow you to write off.
So you have to have that classic study. If let's suppose you didn't do the cost segregation study and you had this 27 and a half year, let's say 10 years down the road, you had to replace this roof. You could still do the same thing. The only, no, you
Tell me. So my question, push back on you, is how do you know what that roof cost? You have no idea how much the roof cost.
oh yeah, okay. So because you didn't
So
do the
the only reason you can write off the roof is because you have this study that says, our study says the roof on the initial purchase of the building is X. Now we have to pay Y in order to replace it. And that's what we're working with. If you don't have a study done, you have no clue what the cost assignment is.
Okay, but let's suppose that I had the old typical method of 27 and a half years, and I'm 10 year into my 27 and a half years. Now I have to replace the roof. Yes, I don't know what the roof value was before, but I do know that the total house value included the roof, cost in there. So now if I spend $70,000, I could add that 70,000 into my cost basis, no?
Oh, of course. You have to depreciate the new roof into to be depreciated, but
My
there's a
cost
big
basis
difference.
will be higher,
What's
right?
that?
My cost basis will go $70,000 higher in that
Yeah,
example.
yeah, yeah, absolutely.
So
Yeah.
I
So
don't lose the money. I don't lose the money. It just go further. You don't get it early enough. That's the benefit, correct?
right, you don't get to write off the cost of the old roof. It just continues to be depreciated over the remaining useful life of 27 and a half years. So if
Uh-huh.
you got 10 years in, well, you got 17 and a half years left before the original cost of the roof is totally depreciated. Where if we have a cost seg study, we write it off in the year that the roof is replaced.
So the lesson learned here is if you have a big item coming, you're better off doing cost segregation study upfront before you replace it. At least in this way, you know what the value of that thing is, at least even now. So you could actually write off that. I mean,
Yeah,
depreciate that.
yeah, and I think in what you just said, there's something just to talk about real quick. So the answer is yes. I mean, you can do a cost seg study anytime you want, and I always recommend in the first year of ownership, especially if you're going to keep the property long term.
Right.
You're going to front load depreciation, save on taxes up front, and then be able to write off anything that you have to replace over time. Uh, but you can't, like, say you get 10 years, 15 years in, you say, I want to do this cost seg study. I got some big capital improvements happening. good valid reason to do it. But so the answer is yes, you can do it down the line. Now, what happens? The study is going to say, okay, they're going to say, okay, over the 10 years that you own this property, this is the depreciation you took. And then the study is going to be done, and they're going to say, you could have taken this though. So over that lifespan, that time, maybe you wrote off $100,000 of depreciation. And the study comes in and they say, whoa, you could have taken $250,000 over time to this date. What happens? Well, in the year that you do the cost seg study, you have this report. It says this is what you are allowed to take. Now you can actually take all that extra depreciation in the year that you had the cost seg study. And it's called the 481A adjustment
Mm-hmm.
to report prior depreciation that you
Mm-hmm.
could have taken. And the downside of doing it years later is that you have to file something called a 3115 change of accounting method with your tax return.
Mm-hmm.
It's kind of it's bulky. There's a lot of work to it. I charge a lot more in those years because there's a lot of work on my end that I have to report to the IRS on your behalf. It
Mm-hmm.
says, hey, we're taking this extra depreciation. Here's the reason why. There's all this other factors that go behind that report to substantiate that it's okay if it's ever challenged. Um, if you're buying property and you have any intent or cost seg study, the first year just makes sense. Just for the front loaded depreciation, never mind the savings with your CPA, and then moving forward on large ticket items. It just yeah, a lot of people nowadays you can't get a three family. Well, we're in Massachusetts, and you can't get a three family here for under 600,000 nowadays. So that alone, that price tag is well worth the cost of the cost seg study. It's fairly cheap money when you consider how much more you get to write off in the first year.
Okay, so couple of stupid clarifications on my end because there are a lot of people are naive like me, they're not smart like you. So let me ask you this. We are talking specifically for rental property. This does not apply to your residence you're living in, correct?
Correct. Yeah. Residential. If you live in the property, there's none of that. You don't get to depreciate the cost of your house because you live there.
I
This
just
is
want to clarify
this is business.
that.
Income producing property is what
That
this this relates to.
right. The second clarification is my understanding was that the big beautiful bill deals more with the commercial real estate, not residential. That's not correct either. It applies to both.
No, it applies to all, business income producing properties.
Okay.
It applies to both. I mean, there are different useful lives for residential versus commercial. Now, the commercial, obviously, 39-year life versus 27 and a half years. If you're capturing 5, 7, 15-year qualified leasehold improvement property, obviously you're capturing that a much quicker time than on a commercial than a residential. There's obviously 11 and a half years more on a commercial property to capture those costs. So I guess in a certain way it benefits the commercial a little bit more because you're getting it that much quicker, but it's treated very similar whether it's residential or commercial.
Okay, and commercial would be anything more than 3 units. How do you qualify commercial versus residential?
Typically, it's just residential is residential. There are large.
No,
Uh,
like if somebody has an 80-unit condo, that's commercial.
yeah, there's a cutoff there. I mean, typically, yeah, I don't know this. Off the top of my head, I don't remember what the cutoff is to. I know for commercial lending purposes with banks, they consider anything more than I think 5 units to go under a commercial
Okay.
loan. But I'm not positive off the top of my head what the unit load is for to be considered commercial for 39 years.
Okay, another naive question in that regards, that if you have other income and you are actually have high tax bracket, then it make more sense to do this because I have a friend, for example, both husband and wife are working, they make good money, and they have a rental property. They know that they're going to retire and their income is going to reduce. So it definitely will benefit them if they do that, this study right now and take these things in earlier year when they are already having two income as well, and plus the rental income, and instead of being later when their income is going to be less, so their tax bracket can go down. Correct?
Sure, that's absolutely a great tax strategy if they know that's going to take place for sure.
So then the steps would be that you first of all need to do this study, and then you talk to your tax advisor to implement the benefit of that study. Correct?
Yeah, so you need the cost study first, and then I mean there's strategy around what year you do it. If you don't do it in the first year, that you can always say something's coming down the line. You can always do it in a year that you have something big going on. It might make sense in that year. So there's a lot of different ways to think about it.
So the way the steps would be that you consult with your accountant, your tax advisor, and understand your situation, and then ask them, hey, it doesn't make sense for me to utilize this tool. And if they say yes, I mean that's exactly how this question came to me. And then you go ahead and find appropriate company. I mean I'm sure there are some software online where you can do it yourself.
I don't recommend doing anything yourself on this level because if now let's face it, it's
Yeah.
only if you get challenged by the IRS, right? You have to substantiate what you're doing, why you're doing it, how you got there, and does it make sense? They're either going to allow it or disallow it.
Yeah.
You do it yourself unless you have a really good contractor that's keeping track of what everything costs and
Mhm.
can give you a report, and that might work. But that's on new building, right? And
Mhm.
then, but there's third parties out there, like I said, for $600 on a six
Yeah.
family or less. 600
That's
bucks is cheap money to front load this kind of stuff. And
yeah.
then on commercial property, sometimes it can cost a couple grand. Like I said, all the way up to it could be 20, 30,000, depending on the type of properties. So, but third party is always recommended. I would never tell any of my clients to ever do this themselves.
That's good.
Um,
No,
you're not going to find a free
that's a less
online
burden on you as well.
software.
Yeah. Yes, that's a less burden on the tax advisor as well. Because if you get, garbage in, garbage out. So if you take a garbage, then it's more liability on the tax advisor as well. So that makes sense.
Right.
Okay, so the other question in regards to that, what are the cons? Now, let's say if somebody did this segregation study and start implementing and taking these things earlier. Now you already have it. If you don't have any tax owed, then of course it will, you can roll it over to the next year, just like any, I'll say any dividend or anything else. Um, but is there any cons to doing it that you have? I mean, do you lose any money if you do it now versus you do it like a typical 27 and a half typical years?
Well, it really depends on your tax situation. I mean, that there's always a chance that somewhere down the line it would have made more sense not to have done it, but there's very few cons. Like, well, let's talk about a situation where it might not make sense. Well, you bought a property, your intent is to just keep it maybe 5 years and flip it, or something like that. And depending on what you have going on, maybe the cost seg study doesn't make sense.
Really, I
You
thought
know,
it would make more sense now because you want to keep it for 5 years. You take advantage of it sooner.
yeah, I mean, depends on
But you
because you
have
have 12,
back.
but on a sale you have 1250 recapture.
Yeah.
So 1250 recapture is based on the depreciation taken, during the use of that property against taxes. If your tax situation is going to change, well, that 1250 number could increase your tax liability upon sale. So, I mean, there's is fairly unlikely, but I'm just trying to cover like because there aren't many negatives to a cost seg study,
Mm.
but that could potentially come into play.
Okay, very good. No, that's great. Is there any other caution, Steve, you think of? Otherwise, we're going to summarize because we like to keep our discussion under 25, 30 minutes, and we're 25 minutes now.
Sure.
So help me
The other
overall.
thing I would just note here is that the cost seg, the bonus depreciation is federal only.
Very good.
So some states follow. They, each state treats it different.
Mhm.
Massachusetts says nope, you get no bonus depreciation. They accept the cost seg study, so you still get that property at 5, 7, 15, but it's based on either straight line or makers modified accelerated depreciation. Um, so you do get it quicker, but you don't get 100% in the first year. And then, so what happens is it's called a federal state depreciation difference.
Mhm.
So for Massachusetts, for us, in the first year, your taxable income to Massachusetts is going to be higher than federal. And then over time, it kind of catches up and adjusts. So I think that's an important piece to keep in mind.
Right. But some states, like for example, California, and some other states don't. New Jersey, they don't accept that segregation strategy at all. But I thought Massachusetts does accept it, like you said, but they do
They
not.
accept it. So all states have to accept it. So they have to accept your useful lives that you utilize.
Okay.
They just don't accept the bonus depreciation. They all treat that differently.
When you say
Um,
bonus depreciation, please help me understand. Uh,
what's that?
what does bonus depreciation means?
That's the one big beautiful bill. That's what we're talking about. The 100% in the first year. We call that bonus depreciation. It's under 168
Okay.
code in the IRS code, but
Mhm.
we call it bonus depreciation because you're getting bonuses. It's all in the first year, and then over time they, like I said, you up front instead of over the 39 years.
So let's say you do the tax segregation study and you got about $250,000 worth of items. They are 5 to 7 to 10 years, but you can lump all those items and take all that depreciation in the first year.
Yeah, anything under 15 years or less, you can take it in the first year.
Wow, that's nice. Okay. And then I was also reading, and I may have misread in the big, beautiful bill. Is there a deadline when you actually have bought the house or when you do the tax segregation study to benefit from it, or there's no deadline?
Well, for 2025, the cost seg has to be done, like the purchase of the property has to be after like January 19th, 17th, and 19th when the bill was officially signed.
Mm.
So that's one little caveat on the timing of it is the acquisition on new acquisitions have to be after the date the one big beautiful bill was enacted.
So if you own the property before, but you do the tax seg study, um, after January 17, is that okay or that's not going to apply?
Actually, I haven't looked into that piece. I know that was like an outstanding question of, if you owned it prior, would you be held to the 40%,
Mhm.
which, or the 60/40 for the current year versus the 100%? I haven't, there hasn't been a whole lot of additional information that came out around the bill yet. In some of these um, more detailed items. So I don't know 100%. You would at least get the old rules
Mhm.
of 40%,
Mhm.
but I'm not sure if you could. We could take 100% based on if you own the property prior.
So that the rest of the 60% will continue with the 27.5 year rule, or does that shorten as well?
The what?
So 40, 60. So let's say $250,000 was allocated to be in the less than 15 years of
Oh yeah. So
depreciation.
you get the 40% upfront, and then the remainder would be depreciated over 5, 7, or 15 years.
5, 7, 15, not 27 and a half.
Well, no, because we had the cost seg study,
Right.
so we know what the useful lives are. So that's what we're recording them at. So we have 5-year property, 7-year property, 15-year property. That goes in our depreciation schedule, and we take the bonus depreciation, and then the remainder would be over the useful lives that were assigned to those that pieces of the property.
So I just want to summarize this that let's say it was $1 million property and we did the cost segregation study. And in that study, $250,000 worth of portion of the elements of the property were less than 15 years schedule.
Yep.
Now, the, according to the old rule, that would be 40% of that you can take depreciation on the first year. 40% of the 250, not 40% of that million.
Right.
40% of only the those items. Now
Yep.
that the 60% of those items would be like the way you said it, 5, 7, or 15 years, as they have been stated in the text in the cost segregation study. And now that 250 was covered, and then the rest of the 750 will continue with the 27 and a half year schedule, correct?
Correct.
Okay, I just wanted to clarify. So I think that really conclude our discussion today, Steve. I really want to thank you, and I want to ask you again if people want to reach out, because even in our last episode, a lot of people are interested to talk to you. So if you people want to reach out to you, Steve, what's the best way to reach out to you?
I mean, you can Google us anytime and find our information, but our office number is 508-757-6391,
Mhm.
and O'Connor Maloney, and my name's Steve Thibodeau. I'd be happy to talk to them if they have any questions.
Okay, and it's the Wooster firm, and
Yeah, we're based in Worcester, Mass.
yeah, and they're right in downtown. And Steve just stated his name and his number. And if you Google Steve, you can clearly find him and his firm, O'Connor and Maloney. And Steve, with that, I really thank you. It was very useful session. I definitely learned a lot, and I'm sure people who are listening to us on LinkedIn, Facebook, YouTube, or Twitter, everywhere else, they will benefit from it. We will also, post on YouTube video, and you could benefit from it now and later. Thank you, Steve.
Thank you.
Appreciate it. Okay. Have a good rest of the day now.
You too.
Okay, bye.